Want to build real wealth in 2025? Then forget get-rich-quick schemes and focus on what actually works. In this video, we're going to break down 7 powerful investment strategies that can grow your wealth smartly, even if you're just starting with a small amount like 500 rupees per month. We'll cover everything from mutual funds and SIPs to REITs, index funds, and even a bonus strategy that proves you don't need a lot of money to start building wealth. Plus, I'll share a few beginner mistakes to avoid and tools you can use to calculate your returns. So stay tuned till the end, and let's get started. The first strategy is all about starting early and harnessing the power of compounding. Albert Einstein once called compound interest the 8th wonder of the world, and he wasn't exaggerating. When you start investing early, even a small amount like 500 rupees a month can snowball into a massive corpus over time. For example, if you invest 500 rupees every month for 20 years at a return of 12%, you'll have invested just 1.2 lakhs, but your final amount could be over 5.9 lakhs. The best part? Most of that growth comes in the later years thanks to compounding. This is why delaying your investment, even by a few years, can cost you lakhs in the long run. Next, we have SIPs and mutual funds. SIP stands for Systematic Investment Plan, and it's one of the easiest and smartest ways to invest consistently, especially for beginners. You don't need to time the market or have a huge amount to get started. Whether it's large cap, flexi cap, or index funds, SIPs help you build discipline while taking advantage of rupee cost averaging. You also get the benefit of compounding returns over time. Bonus tip: look into ELSS funds if you want to save taxes under Section 80C while investing. Third, diversification. This might sound boring, but it's the secret sauce behind long-term wealth building. Never put all your eggs in one basket. Diversify across stocks, mutual funds, fixed income options like FDs or PPF, and even real estate or REITs. By diversifying across different asset classes, you reduce your risk while keeping your returns relatively stable. For instance, a 25-year-old might lean more toward equities, while a 40-year-old might choose a more balanced mix with debt components. I'll show you a sample diversified portfolio to help you plan based on your age and risk appetite. Speaking of risk, the fourth strategy is knowing your own risk profile. Are you an aggressive investor who can stomach volatility? Or do you prefer a safer, more stable path? You know, many people lose money not because their investments were bad, but because they panicked and sold during a market dip. That's why it's crucial to have an emergency fund, at least 3 to 6 months of expenses before you invest. Also, make sure to include some safe options like PPF or gilt funds to balance your portfolio and protect against downside. Fifth, let's talk about real estate and REITs. Traditional real estate investment can be a great long-term bet, but it's expensive and not liquid. That's where REITs or real estate investment trusts come in. REITs allow you to invest in commercial real estate like office buildings and malls with as little as 500 rupees, and you get rental income in the form of dividends. A good example in India is Embassy Office Parks REIT. This is honestly a smart way to get exposure to real estate without needing lakhs of rupees up front. The sixth strategy is all about ETFs and index investing. Warren Buffett has said many times that most people should just invest in low-cost index funds. Why? Because over the long run, very few active investors beat the market. Index funds and ETFs mirror. The performance of indices like the Nifty 50 or Sensex have extremely low expense ratios and offer solid long-term returns. For beginners, these are excellent ways to get market exposure with minimal hassle. Now, here's a strategy most people overlook: investing in yourself. The returns from learning a high-income skill, taking a course, or improving your career prospects are often better than any stock market return. The more you learn, the more you earn. This might mean learning about personal finance, coding, digital marketing, or even starting a side hustle. You are your greatest asset. Invest wisely. As a bonus strategy, I want to show you how even small investments can turn into big results. Let's take that 500 rupees per month example again. If you increase it by just 10% every year and invest it in a good mutual fund returning 12%, you could end up with over 35 to 40 lakhs in 25 years. That's the magic of consistency and gradual scaling. You don't need to be rich to start investing. You need to start investing to become rich. Let's quickly recap. Start early to take advantage of compounding. Invest via SIPs and mutual funds. Diversify your portfolio. Understand your risk profile. Explore real estate and REITs. Consider low-cost index funds, and most importantly, invest in yourself. If you stick to even a few of these strategies consistently, your future self will thank you. If you found this video valuable, hit that like button, subscribe for more finance content, and comment below which strategy you're planning to start with. I reply to every comment and would love to help you tailor your plan. And don't forget to check out my next video on picking the best mutual funds for 2025. It's packed with actionable insights. See you there.